Hello, and welcome back to another episode of Money Talks with the Wealth Whisperer.
I am Rob Kosick, the owner and founder of DLAC Wealth Advisors, and your personalized wealth educator.
And I'm Danielle Kosick. In this episode, we'll cover one of the most simple yet misunderstood topics in all of personal finance. You know that dreaded question, how comfortable are you with risk? Rob, I'll let you take it away.
In my 30 plus years experience, I've never actually seen any peer, competitor, advisor have this discussion in a manner that I believe it deserves. And when I talk about my experience, my first 3-4 years in this industry, I worked in a phone center. And the job of the 100 people sitting around me, or the 25 at the time that were actually working for me, their job was to actually help people understand the level of risk that they should be taking. That was the probably primary discussion that was taking place. I've seen this sort of morph over the past 30 years into a CYA, a discussion where the questions have been written and vetted by a legal department. My goal through all this is to have it be an education. And so sort of the example that I go to is if somebody were educating me or working with me in terms of trying to determine how much risk that I should be taking, and they told me that, okay, here's our baseline starting point, and that's stocks historically average 10% per year. That 10% per year would mean nothing to me. How much trust and confidence would I have that 10% could continue? I'd have zero. Okay? So, in essence, today, I want to make sure that we talk about you as an individual investor are taking an appropriate risk. And the reason I think this is extraordinarily timely is valuations of today. I'm not saying the market's going down tomorrow. Valuations matter, and they're one of the most important variables that dictates, how you should make investment decisions. But as we've seen in the past 10, 11, 12 years, markets can stay overvalued for an extended period of time. So there's nothing that we're going to do today that I want anyone to make any investment decisions based upon. This is not an investment discussion. This is a risk discussion.
Tell me more about the downside to how the industry treats this process.
It's sort of two parts. One is determining the risk, and then what is being done with the risk. Okay. So one is about the education process. And the education process, as I was speaking to before, is if somebody says that stocks have historically done 10% per year, and I'm going to talk a good amount more about that education process in a little. But right now I'm going to talk something about a Monte Carlo analysis. A Monte Carlo analysis is almost all of my peers. And the reason I feel confident making that statement, almost all of my peers, is every financial planning software that I've ever seen has a section of which the advisors ultimately end up spending a lot of time and a lot of energy behind trying to tell clients this is the percentage chance that they're going to achieve their goal. Okay? So this Monte Carlo analysis is an issue. So before we talk more about the education, I absolutely want to make sure if you're doing a Monte Carlo analysis on your own or you're working with an advisor that's doing a Monte Carlo analysis, don't put a lot of credibility into it. And the reason I can say that is garbage in, garbage out. So if we look at what Monte Carlo analysis is, it's a data-based exercise. So what they say is, what is the data set? The data set is the past. What does the past have to do with what the future will be? Great. I implied it before. Over the past 75 years, the average PE ratio of the S&P 500 has been, 75 years. Yeah, the S&P's been around about 75 years. So over the history of the S&P, The average PE's probably been between 15 and 16. If I'm off, I ain't off by much. As of the taping of this, it's probably right in the 21 to 22% range for current year. That's a pretty wide discrepancy. So if you sit there and say stocks have made 10% per year during that time period, you have PE expansion in there. All right. So if it's going to sit there and say, great, I'm using a data set of which stocks have historically done 10%, but one component of that 10% per year has been expansion of PE, we have an issue. We have a big issue. It means it's very, very likely you're not going to be able to replicate what's in that Monte Carlo analysis. Along with it, same thing. So the point that I'm ultimately going to see that I'm making is they're probably telling you're in a better position than you actually are. And I don't want you to get overly concerned because I think at least most of my clients are very frugal, very conservative. And ultimately, when we run the numbers, we beat those numbers up and we make sure that we're looking at it in, not just what we expect to happen, but with what I'll call a reasonable worst case scenario. The worst case scenario, of course, is the world comes to an end. What I tell people all the time, if the world comes to an end, it doesn't really matter what we're doing. Okay? So the second component as it pertains to the Monte Carlo analysis is bond returns. If this Monte Carlo, data set that you're using is 75 years or 100 years of the bond market, it's using an average of 5.5%, 6.5%, maybe even 7% for bonds. Okay? As it pertains for bonds, and this is where some of the education starts to come in, is that you have a pretty good idea what you're going to do the next 20 years in bonds by one simple factor. That is, what are rates today? At the time of this taping, the 10-year Treasury note is yielding 3.75%. Okay? So if I'm buying a bond fund, which if you're a client of mine, you're probably not buying a bond fund, or you're buying individual bonds. Hopefully you have some type of diversification or ladder structure. What a ladder structure would simply mean that you have bonds to mature at different points in time. So you may have a 7-year, a 12-year, a 20-year. So if you were to buy a 20-year Treasury bond today, you would get 3.8, 3.9%. You know that already. You don't have to worry about variations. You know what the return's going to be. Well, the downside, if you're making 3.8, 3.9 before any fees, is the Monte Carlo analysis is maybe assuming that you're averaging 6%. That's risky. That's scary.
Those are some very interesting points about bonds and debt markets. I really hadn't thought of that. I guess that begs two questions. Why have stocks done 9 or 10% over the last century? And if you had to guess, what will it all look like over the next 3 decades?
All right, Danielle, I'm actually going to take it a step further. I'm going to talk about stocks and bonds. All right. The first thing that I do when I talk to people about risk is, as I talked before, is I educate them. And I educate them on the fact as to why stocks have done what they've done over the past whatever years. Okay. There are 4 components that are going to make up a stock return. Or market return. And that's going to be GDP growth, inflation, dividends, and the last I talked about before, which is PE expansion or contraction. If you have a PE expansion, it's actually adding to your returns. So let's look back the past 100 years. Stocks have done 10%. What has global GDP been on average over the past 100 years? It's been around 3%. What have stock dividends? If you are a student of dividends historically, you know where we are today. Dividends on the S&P 500 are close to maybe as low as they were in 1999. I promise you it's not. If it is higher, it ain't much higher. So it's a good amount below 1.5%. The past 100 years, it's been close to 3%. Inflation's been about 3%. Okay, So I got 3, 6, 9. You say stocks have done 10. I'm missing one. Oh, that's that PE expansion. So I don't know each of these three components that I used. I'm not actually giving you the exact, but I'm telling you that I'm within very close proximity. And as I said, if historically PE ratios were much lower than they are right now, then we've had some expansion, and that's added to stock returns. All right. So if we were to sit here today and say, what do we guess PE ratios are going to be tomorrow? We have no clue. Tomorrow, I guess we probably have an idea. But if we were to say 10 years from now, you don't know. 20 years from now, I don't know. 30 years from now, I don't know. All right. So many decisions that I make are based upon statistically. Is there a statistically good chance that PE ratios will be lower in the future than they are now? Yes, statistically, we would say, based upon history, the chances are that they'd be lower. Okay, so we got a negative right there. All right. Then we have dividends. Let's say dividends give you 1.2% per year over the next 20 or 30 years. All right. Inflation. Obviously, having a discussion on inflation right now is very interesting, but if we had to say the world doesn't come to an end, things normalize a little bit, let's throw and just use 2.5% in this particular example. And it's unfortunately at the growth or the lack thereof of population worldwide, we are going to continue to see, I would certainly suspect, more and more ultra low class people start moving up the food chain, getting to upper lower class to middle class, because GDP is driven by the consumption of goods and services. So let's say hopefully it does 3. So I got 3, I got 2.5 on inflation, I got 5.5. Let's hopefully, I said 1.2, let's do 1.5 for simplicity. 7, PEs contract. Maybe I do 6. So I don't know. Is 6 supposed to be the baseline over the next 30 years? This is not a discussion today about prognosticating what stocks are going to do, but it is about setting expectations. I did mention a moment ago is I'm going to take it a step further, and that was just to follow through on what I was saying on the bonds before. If I'm going to prognosticate and try to make a target return, which I think is extremely important in determining one's risk tolerance, if you're looking at bonds, probably 3 to 4% is something that you should be putting out there that you expect to be able to get from bonds over the next 20 or 30 years.
Wow, that is a lot to unpack. If it's okay with you, I might ask you a couple questions about that over the next few weeks. Moving on to that dreaded risk tolerance question. I know you mentioned earlier how you've simplified the process. I was hoping you'd give us a walkthrough.
I'd be more than happy to. The way I look at it is 3 components. The first is you want to create a baseline. The process of creating a baseline, what I do is I use target retirement funds. For those of you who don't know what a target retirement fund is, they are the dominant vehicle that are currently being used within 401k plans. Very simply, what a target retirement fund does is it says, when are you going to be 65? It just takes an assumption of a hypothetical investor who's not personalized at all. And it says, okay, you're going to be 65 in 26 years. All right. You take that 26 years, you add it to the current year, it's 2024, that's 2050. And so whether it's Vanguard, Fidelity, T. Rowe Price, whoever it may be, they're going to have a 2050 fund. What is Fidelity, Vanguard, and T. Rowe Price doing? They have some high-paid actuaries that are ultimately running all sorts of numbers and saying, based upon your age, we believe statistically this is what your allocation should be. And their money managers make investment selections as to what stocks, what bonds to be in. I use that as my baseline. Okay. As I move from there, I then personalize 2 things. Because if I'm going to determine someone's risk, I'm determining someone's risk.
So now that we know what the baseline is, let's talk about feelings around risk.
What I tell people is I want to make what can certainly be considered to be subjective and make it objective. All right. The way that I do it, I feel I make it a pretty easy or simplistic process, is I try to allow people, based upon points of reference, to give an objective answer. And the way I phrase it is this way. I say, rate yourself on a scale of 1 to 10. 10 is an individual who says, you know what? After listening to you speak today, here's what I think I want to do with my retirement assets. I'd like to close out the account because I'm going to get on a plane. I'm going to go to Vegas and I'm going to put it all on red. That's a 10. Okay. And then I said, 1 is, you know what? This meeting's over. I don't trust you. I don't trust banks. I don't trust anyone. I do trust my shovel. I'm going to go in the backyard. I'm going to dig a hole. I'm going to put all my money in it. I'm going to call that a 1. And then I say a 5 or a 6 would be looking inside yourself and saying, really, when it comes about, I'm probably feel no different than the average person as to it pertains to how much risk I'm willing to take on my retirement savings. All right. So when someone sits and they work through that number, they give a number. And that then should take the baseline and move it in one direction or the other. If somebody comes back and says that they're a 9, and maybe their age said they should be 65, 35, 65 in risk, 35 in non-risk. Another whole discussion as to what makes up risk and what makes up non-risk. But that's more personalization to yourself or with you and your advisor. It's a whole nother discussion. So let's call it risk and non-risk. 65, 35 is that's what your baseline is. That's what the target retirement funds, that's what the actuaries have told you should be. If you're then a 9, well, ultimately then it's going to move you way up that scale, way above and beyond 65% in risk.
So you've mentioned baseline and how you feel about risk. Is there anything else?
Yes. And this is pretty darn important. And what I call is, what does your situation dictate? And this is where people that do things on their own often are far off where I feel maybe they should be. And so I like the concept of rule of thumbs, but I don't think there are a lot of rule of thumbs that should pertain to everybody. In this particular instance, I sort of do. And what I mean by that is clients are often conservative or aggressive, and they don't care about anything else. Where they are in life, if they're doing things themselves, if they're doing things themselves, or they make a decision at a point in time. Everything in terms of what we do has to be on a sliding scale over time, meaning I want to be able to invest in a capacity where I'm like this today, but I could be like that tomorrow, and it does not involve buying or selling products. Okay. So the rule of thumb that I mentioned is I just came up with what I call a 7-year rule. And the 7-year rule is any money that you may need in the next 7 years to pay bills, whether that's buying food or paying rent, paying a mortgage, etc., that money should not be in the stock market. It's very obvious. In the 30 years that I've been doing this, the first 7 or 8, there was no downside risk. The market, for the most part, just went up. For the past 25 years, if you've been exposed to the market, you've seen all the volatility as it possibly can exist. You've seen the market go down in the early 2000s. It'd be 7 years before you ever even got back to where you were. We really haven't had that much of that, even though 2008 was an implosion. Maybe took 3 or 4 years to get your money back. But I use 7 because I think that's just a good way of sitting there and saying, if the market does drop 50% tomorrow, the last thing in the world I want to be doing as an investor is selling an investment at 50 cents on the dollar to pay my bills. Makes no sense whatsoever. Okay? So if I have the next 7 years of the money that I need to pay bills, not in the market, invested in something that is secure, that I know what it's going to be worth in the future, then the market can really run its course. So it goes even a little bit beyond that. And so what I do is I made up a question. And that question says, how long will it be before I will spend 75% of the assets that I have today? And then I vary it based upon how many years, 3 to 5 years, 5 to 8 years, 8 to 12 years, 12 to 17 years, 17 to 22 years, 22 years and beyond. And each one is then going to dictate. So sort of, a norm to me would be about 14 years. Okay? So if the answer came in and it was, I'm going to spend 75% of what my investable assets are within the next 14 or 15 years, it's not going to move your risk tolerance up or down. If it was 50 years, in that particular instance, it's probably going to move your risk tolerance up, and your appropriate allocation may be a little bit higher. If it's, I'm going to spend 75% of my money in the next 10 years, clearly that's going to force down the level of risk that you should be taking. So in conclusion, I think it's incredibly important that people, when you're determining your risk, get a baseline. Think about how much risk you're willing to accept, but do not forget, what is your situation dictating? So I want to thank you all for being here again. I look forward to speaking to you next time.
For all podcast or guest-related questions, please email us at dlacadvisors@dlacadvisors.com. For all questions or inquiries into the services that are provided by DLAC Wealth Advisors, please contact us at elliot.singer@dlacadvisors.com. That's Elliot with 2 T's. Please also visit our description for helpful links.